I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling an enterprise view of exposure. Today's guest was the very first guest on this podcast over 250 episodes and 5 years ago. She's been on since as part of a multi-person episode, but it's great to get her back on the show one-on-one. With the new Lloyd's chairman, CFO and CEO all now announced and either just starting or about to start their tenures, the timing couldn't be better. The Lloyd's Market Association, the LMA, represents the interests of underwriting businesses at Lloyd's, and Sheila is a very effective leader, spokesperson and focal point for that hugely important constituency. In this interview, she sets out the LMA's priorities as the Lloyd's baton is passed to a new team. Sheila is crystal clear on what her members want, and this interview is a tour de force. We cover everything from the LMA's top ask of the new regime all the way through to the future of underwriting and capital provision in the market. Sheila's very direct, and our conversation doesn't duck thornier topics such as the market's frustratingly slow technological reform process and the difficult-to-navigate cultural reform agenda. By the way, we made this recording a few days before the unveiling of Patrick Tiernan as the next CEO of Lloyd's, but the messages for the incoming leader are loud and clear and still current. The LMA is an essential and vibrant trade body, and Sheila is its equally essential and vibrant voice. And I think the result is essential listening for anyone with an interest in the future direction of the Lloyd's market. Enjoy the podcast. Sheila, welcome back to the Voice of Insurance. It's really great to see you again. And I must mention to any newer listeners that Sheila was the subject of episode number 1.
Yeah, that was way back when, Mark, eh?
5.5 years ago. So that was December 2019. Yes. Good to see that you're going strong. So is the Voice of Insurance. So thanks so much for coming back.
Thank you for having me.
You've been running the LMA all that time. What's the top of your agenda right now?
Well, our purpose at the LMA remains precisely what it was when we first spoke back then, which is we exist to make the market a better place, both for our individual members who are the managing agents within Lloyd's, but also for the market as a whole. So how can we make this market a better place? And that's fundamentally why we exist. Now, in terms of what's top of our agenda right now, well, obviously it's the transition in leadership that's going on within the corporation of Lloyd's, with John stepping down as CEO, Sir Charles Roxburgh coming in to replace Bruce, and Alex Cliff replacing Burkhart Kiesa as the CFO. So a lot of change going on at the top of Lloyd's. So I'm very focused on how do we manage that leadership transition within the market, keep people calm, keep on keeping on. Let's make sure that we keep our eyes on what we're here to do, which is to provide those policies for our clients and ensure that we're providing the best solutions possible to them. But aside from that market, that leadership transition, additionally, we're looking at the market performance across the market and the headwinds that are facing that, as we've seen from some of the pricing indices and so on that are out there at the moment, and also the political landscape that we've got out there with the US government. That doesn't stop us carrying on with what we need to do on a day-to-day basis. So we're doing a lot of work around simplify and digitize this marketplace. What can we do in that space? We do a lot of work around regulatory advocacy. I was with the PRA yesterday, we're having the FCA into the LMA board in a month or two time.
That bread and butter work never ends.
All that bread and butter work never ends. And underwriting solutions, some of the stuff that we've done on enhanced underwriting on the lead follow side of things, as well as our work on culture and training with the recent MPMP stats that came out around the market demographics overall that came out of Lloyd's. And there's some interesting stuff within there that we need to focus on, and we need to keep changing and pushing our market to change.
That's a good summary of everything I want to talk to you about. So that's good. It's good that we were on the same page, Sheila. Well, in terms of the LMA, you must be bigger now. The market's grown. I presume your membership's grown because there's so many new businesses underwriting at Lloyd's.
Yeah, I mean, when I first came into this role back in 2019, in January 2019, the size of the market was 40 billion. We'll hit 60 billion this year. So the market has undoubtedly grown, and the performance has grown with that in terms of our combined ratio overall and how that has improved over time. But there has been a huge amount of change that the previous regime has implemented. The PIBO framework, for example, which is Principles for Business Oversight, moving away from a tick box form of regulation by Lloyd's into a principles-based viewpoint. There's been a huge amount of work on digitisation, particularly digitisation of the back office and where that has gone. So there's been a lot of things that have changed, and culturally a lot of things have changed as well. Back in, I think it was July 2019 was when the Bloomberg report hit. And that led to a step change in how we address cultural matters across this marketplace. So A lot has happened, but there's a lot more to come. And I think the next regime within Lloyd's is going to have its work cut out. It's not just continue on with what has been done before.
Well, let's talk about that. It's quite a unique situation. So usually we tend to have a sort of staggered new chairman, then a couple of years, then new CEO, then a few more years, then new chairman, new CEO, and CFOs probably staying a bit longer. But yes, it's rare that we get this sort of stars all coming into alignment. You get sort of multiple eclipse or whatever it is, sort of situation where three are all going at the same time now, all changing. So one of the first people on their list to phone, and you're all in the same building. So it's like literally, can you get in the lift and come up to the 12th floor, please, Sheila? We'd love to have a cup of coffee and a chat. And I'm sure they're going to be gauging you on where you think the state of play is and what your membership would like them to be doing. So when you get that call, I'm sure you will get that call and say, hey, with a new gang, what do you want to see? What's top of your agenda? What would you be responding to them to say, right, these are the three top things you absolutely got to get hold of?
Okay, so I think in the first instance, I'd say there's some really good stuff that has happened over the last few years that we need to protect. So first of all, the focus on performance and driving a strong performance over the cycle has been incredibly strong. And we need to protect that and make sure that we maintain that going forward. So that's the first thing. The second thing I'd say is in terms of the regulatory side of things and principles for business oversight, we need to protect that. That has been very much welcomed by managing agents because it is about outcomes rather than inputs. Have you got this policy, this tick box, that tick box? It's about outcomes. So we want to protect that. We want to protect, as I already mentioned, around the shift culturally. We need to keep on that journey. So we want to protect that. And I'd say the last thing that we want to protect is around the innovation that has come into play on the capital side of things with London Bridge 2, for example, with modified tenancy rights for names. So that has brought new capital into the market as a result. And we'd love to see more of those innovative capital solutions at play. So number one for me, for the new executive, is protect the performance. We must remain profitable over the course of the cycle, and we must maintain focus on that. But what we'd like to see is perhaps some more transparency on risk appetite overall. What about facilities? How many facilities is good facilities? What percentage should it be? What percentage of our total premium should be delegated authority business? We know today it's about 40%. Is that good, bad, and different? Should it be 90%? Should it be 9%? Let's have that conversation about what is the risk appetite for Lloyd's overall. And we'd like to have that conversation with the new executive. Number two is around capital for me. So as I mentioned, London Bridge 2 has brought in some new capital. The modified tenancy rights has brought in some new capital. Where else could we go with this? Where else could we go in terms of innovative capital solutions overall? And what could Lloyd's do to bring more capital into the market from that perspective? The third area for me is around digitization. And there's been a lot of focus on Blueprint 2 up to now. But what can we individually do as market participants? And how can Lloyd's help us on that? Could we have Lloyd's move to a place where they are recipients of output, just like they've done under the PIBO framework? Well, can we get data to be you're a recipient of data as an output rather than saying it must be handled in this way or that way? So how can we move that forward, particularly when it comes to reporting? So we, as managing agents, submit dozens and dozens of reports into Lloyd's every year.
It'd be quite nice if you had the data. You could say, hello, just open the door to my little data room and it's all there. We'll just go and get it. Don't ask me for it. Don't ask me to fill in a form every quarter.
Completely. And that's where we would love to get to, is to a place where do we provide data to Lloyd's on a daily, weekly, monthly, take your pick.
Every minute, every millisecond that they're interested,
Absolutely.
they should already know, because I suppose the data should be open to them because you're in the market.
And we need to articulate what type of data Lloyd's want. So at the moment it's been very focused on regulatory data, and then separately we submit performance data. Separately again we submit exposure management data. Separately again we submit financial reporting data.
Yes, it sounds like that's a lot of repetition, isn't it? Because it's the same data.
It is, but it's just cut slightly different ways. And some of it is provided centrally through Velenetic, but a lot of it isn't. A lot of it comes individually from managing agents because it's not captured centrally. So for example, the exposure management data isn't captured centrally. So where do we want to go with this? What do Lloyd's actually need? And let's drive that forward and let's get to that type of a conversation around how do we get data to you? What do you need? What does it need to look like? What is the standard of that data? And measure us on that. And then let's, as you said, almost provide the data room, give them the key, and off they go to do what they want with that.
The last time I had you on the podcast, because you were on episode number 1 about nearly 6 years ago now, but about 3 years ago, you launched the Data Council. How did that go? You adopted Accord Global Standards. Can you measure that as being a success, failure, or indifferent?
So we had a really interesting conversation at the most recent Data Council about that, actually, around, so the standard is GRLC, which stands for Global Risk and Large Commercial, which is the Accord standard for specialty business globally. What we would like to see is that all firms would adopt that as their standard. Some already have and are making great progress in that respect. Others haven't, not because they've chosen to ignore it or they don't want to do that standard. There's just been other priorities.
Well, it's just because it's the incentive, isn't it? If there was a great incentive to do it, if it was going to make them a better business and more profitable, then they'd probably do it, wouldn't they? I mean, they'd do it yesterday.
That's part of the case that we need to make out there, and we need to push that harder. But I don't want to end up in the place where we take out there must be a mandate to do X or Y or Z. The case should stand on its own merits because, we see numerous new trading platforms coming out from both brokers and carriers, like, for example, Key on the carrier side. We see multiple platforms coming out, but in order to interoperate with those platforms on a peer-to-peer basis, if that's what firms want to do, they must all be speaking the same language. They must all speak the GRLC language. So we see firms already moving towards that as the standard when they want to get to that place of trading electronically, because they know they need a standard. So when firms get to that point, they are ready to do it and they're ready to adopt GRLC. But there are many firms, there are 56 different managing agents at Lloyd's, all with different risk appetites, all with different appetites for digital and data. And that's fine. That's what they want to go through. But for those that want to push ahead, we see them already grasping hold of GRLC as the standard. I don't want to be in a position where we have to take out a stick and a mandate, because the case should stand up on its own merits. There is no other global standard out there that will meet our needs in the same way. We've already examined that from a Data Council perspective. The Accord GRLC standard is the standard. It is the way forward. I would like to see greater adoption of that across this marketplace.
I suppose it's up for those early adopters to start outperforming. And as soon as they do that, everyone else will say, all right, okay, we better crack on with this.
Absolutely. And to show the benefits that are associated with it, and to show that over time that their expense ratio starts to creep downwards. Now, that hasn't happened to the extent we would like it to happen yet. And that's something that we need to work through and figure out, how do we drive that down?
Well, in terms of that digitalisation agenda, obviously we've had the Blueprint 2 question, and it's been a difficult topic because it's been one of these projects that's been delayed and delayed and delayed. Looking at it now, what do you think the reasons are for the delay? And if it's something that is so difficult to deliver, is it something that's actually deliverable? Is it something that was probably designed wrong to start with?
So the Blueprint 2 programme, let's look at this through, what is it now? For me, this is a re-platform of the back office. That's what's going on right now. And that's what's going on with Velanetic. So we are replacing the systems that they've got in their back office, some of which are over 30 years old. So we have an operational resilience issue. This has become a response to the regulatory demand for operationally resilient systems and processes to be in place.
So it's a bit like when, we had some terrible stories for retail banks in the UK when suddenly all the ATMs stopped working because they were upgrading a really ancient system from the 1980s. And then suddenly it becomes a political issue because people can't get their money out. This is a big bang for the market. And so when you do this cutover, switch over, whatever you want to call it, I suppose you have to get to the point where you're 120% certain it will definitely work. And everyone's got to sign that off, including right up to the chairman of Lloyd's, I suppose, at that point, because it's a resignation issue. If you switch it over and literally we get the cash machines are not working, then at that point, I suppose you're in deep trouble. Is it the design of being a big bang, I switch everything over all at once on the same day? Would it have been better maybe to go more piecemeal?
So let me step back for a second.
I'm not thinking I've got any answers to this problem, by the way.
This isn't easy. I mean, if you look at what the stats are associated with Velanetic, so in terms of the volume and value that they throughput, there's £120 billion worth of premium and claims transactions that goes through their systems every year. They issue out almost 300 million messages to brokers and carriers, the syndicate claims message or the underwriting signing message, all those messages, which is what results in the money flowing between the counterparties. On the IMR, there are 100 million different documents at the moment on the IMR, which is the Insurers Market Repository. So This is not simple stuff to change. It is not simple stuff to upgrade. And you're absolutely right to call out the banking example. What happened with TSB is actually what led to the operational resilience requirements that the PRA and FCA then issued out over the last few years. So that's why those requirements are there, to be operationally resilient. That's why we need to upgrade these systems. And I always describe the Blueprint 2 project as it's bookended by the operational resilience imperative from a regulatory perspective at one end, and the desire to digitise this marketplace at the other end. And the desire to digitise this marketplace, we cannot do it on those antiquated systems. We just can't. They can't absorb the data. They can't take it in. There has to be people there to key in the data the way those systems work at the moment. So we have got to upgrade them if we're ever going to digitize this marketplace, because that's how the money flows in this back office. So like I said, it's 120 billion in premium and claims transactions a year at the moment. It grows each year. And it's almost 300 million individual messages that flow. So this is not easy stuff. This is risky stuff to change over, and it is difficult and hard to do with systems which are 30 plus years old. The people who built them are no longer around. They don't work in the marketplace anymore. So we're having to start from scratch and rebuild these systems and get them up to where they need to be to meet the operational resilience requirements at one end, but also to help us drive towards a digitized marketplace at the other end. In terms of what's the right way to implement this, we need to get the systems built, which should be finishing around now. And then we start into testing. So the internal testing within Velanetic and the business users within Velanetic has recently started. So those business users who will be there to input in the data into the claim system, whatever. And they will be shadowed from the summer onwards by some of the Vanguard group. And then the Vanguard group will start in the early autumn. They will start their own testing. So we will know more at that point as to what the right approach is and how best to go about it. So we are working our way through it, but I think people need to remember and do not underestimate how complicated and difficult this is when you're talking about that scale of volume, of value associated with the program overall. This is not easy stuff to do. And I don't know of any program that's as complex as this one. I've certainly not seen it in my time. To do this well, we need to do it safely. We need to do it in a way that protects our clients' interests as well. And it's their money that we need to know that we can still pay a claim the day after we turn on these systems.
Yep.
We need to know that we can get that money to our clients as quickly as we possibly can. That's the imperative here.
Yes, actually, I've got an anecdote on that. I remember back in the days of the implementation of the ECF, when Richard Ward was the CEO, it was the sort of mission to ban the white vans going down to Chatham with all the slips and what were they used to be called? Pans.
That's right.
Premium advice
LPANs.
notes. Yes, L-pans and all these things. Yeah, things that I used to throw into bins, as they used to be called, behind the ILU.
Do you know, Mark, I was the operations director of Exchanging Claim Services when ECF went in 2005. And there was LCCFs was on the claim side, which was London Claim Collection Form, which was a A4 sheet of paper with a box of all the data on it that you would push through. But for me, that was an incredibly complex changeover at that point in time as well. So it just points to how difficult these systems and processes are.
Somebody said to me, well, Mark, that's just a glorified PDF. I said, yeah, it's a good point, actually. Good point. It is just a glorified PDF. And then I went to an exchanging event at the time, which is, what's now Velanetic. And they said, yeah, this may be a glorified PDF. Correct. But, it's such a glorified PDF that Adobe seconded 12 people to come and help us do it because they'd never seen anyone put a PDF under so much strain before. It had never been this business critical.
Yeah.
And to the point, so actually, we nearly broke the PDF. So the kind of the answer to people say, it's quite easy, isn't it? It's just, moving a bit of money around. It's actually often a bit more complicated than we think. So it is a fair point for you to say it is probably more complicated than most people think.
It is. I mean, this links back to the Data Council because we've talked about creating a core data record. And what the core data record does is it creates the record that could then flow into those new systems within the Velanetic back office and then push through ultimately, not yet, but ultimately to almost hands-free processing, as we like to call it. That's where we'd like to get to. And then that becomes instant movement of the records and the financials associated with those records. So that's where we need to get it. And that's why tying it in with the data council and with the CDO records, that's why that's so important. That's how all these pieces will ultimately fit together. But that CDO record, I mean, you talk about that complexity of that Adobe two-sider of an A4. When we looked at it, what are all the data elements that you need? I mean, we had depends on from the most simple risk to the most complex risk, but it varies from a minimum of 80 fields up to, I think it was about 250 fields for the more complex, and we had about 300 fields in total for a CDR. So it depends on which elements of the risk are at play, and not all risks have the same elements at play all of the time. That there's a common core, but they're not all the same all of the time. But my point is, when you're talking about that Adobe, this is complicated stuff to push through those systems with all of those data elements that need to get pushed through.
So you're confident it's all going to happen?
It has to happen because we don't have a choice. We don't have a choice from a regulatory perspective on the operational resilience of those systems. We have got to ensure that our outsourced service provider, who is Velenetic in this case, has the most robust and operationally resilient systems in place. So I always describe it as bookend it as the program. At one end, you've got the operational resilience imperative from a regulatory perspective. And at the other end, you've got that we want to digitize this marketplace. We want that CDR to flow through and be instantly out the other side.
Yep.
And client money's moved accordingly as to meet those client needs.
Certainly, I get the sense that culturally 30 years ago, we might have been sitting here and half the people would be saying, why do we even need to do this? And saying, I quite like paper. And I think now there's certainly a huge, overwhelming consensus of the market wants to move on with this. And a lot of the market is actually ready for whatever the next steps will be afterwards. They're just waiting for these rails. They've got the trains, all the high-speed trains are ready to run, but they haven't built the track yet. So they're just waiting for it to happen. It certainly feels that it will be unleashing a lot. In the meantime, of course, businesses have been able to digitize themselves in different ways, whether or not the central infrastructure is there. You've written a really good report about this. Again, I think it was very commendable of you. I was at an event actually last night where this was being discussed. You've come up with a good term actually for enhanced underwriting, because that includes all algorithm underwriting, broker facilities, fast follow, tracker type underwriting, etc. Out of all that, to distill that, where do you think the best cases have been for the membership of use of things like AI?
So where I see the use of AI happening at the moment is very much what I would term on the expense ratio side rather than on the loss ratio side. So on the expense ratio side, we see improvements in productivity and efficiency going on. So how do you consume unstructured data coming in on email and produce something that the underwriter can then deal with very quickly without having to sit there and go through it all and try and wade through all the unstructured data that is there. So that's where we see most of it happening. What I'm really interested in, though, is how do we move this forward from being an expense ratio play to being a loss ratio play? So how do you move it to being a discussion around how we help our clients to predict and prevent their losses, rather than just focusing on, well, we can make the machine run faster or we can get you data quicker. How do we move this to predict and prevent? And that's where I think the fascinating side of AI needs to come into play in terms of how we respond to it with our clients.
Yes, I suppose that is going to be incumbent on having that data in the right shape.
Exactly. So we keep coming back to data, and we keep coming back to the interoperability of that data between the counterparties in this marketplace. To have that interoperability, you have to speak the data in the same language. The only language we have is a CORS GRLC standard, and we have got to push that. And people have got to start ensuring that their data meets that standard, because that's how you'll be able to interoperate on a peer-to-peer basis with brokers and other carriers across this marketplace.
At that event last night, it was really interesting. I met somebody who was the head of portfolio solutions, an underwriter that wasn't necessarily known for portfolio solutions, told me last night that they're already the biggest department in the whole of their business, and there are only 4 people working there. That's productive.
There are lots of different models out there, and we've explained them in our enhanced underwriting report about all the different models that we see out there. I think what I see a lot of firms doing is they're moving all their facilities work and all their broker facilities work in there, because that needs to be handled in a different way, particularly from the admin expense ratio perspective. So that's what we see already happening. But I think that we need to have a conversation about where do firms, and firms need to have this conversation themselves in-house, where do we truly lead and where are we truly followers? And what is the most efficient and effective way to manage that business as a follower? And that's why we wrote that report. That report specifically doesn't recommend you should choose route A or choose route B or route C. There are different ways available in which you can run your enhanced underwriting or your portfolio solutions or whatever name firms want to put on it. And people need to work out what their own risk appetite is. So the purpose of that report was to inform boards and excos around what models are out there and what are the risks associated with each model and what are the pros and cons associated with each model. It doesn't say that one model is better than another because it depends on what the firm's own appetite is. What I think is more interesting for me is around, well, what does that mean then for Lloyd's and the Lloyd's marketplace overall? And hence what I was saying earlier around the risk appetite of the new executive that comes in. What is your appetite for facilitised business in this marketplace? What should that be? What percentage should that be overall? What's the right answer from a client perspective? What's a right answer from a central fund perspective? And I don't know. Do
you think there's a design
is.
answer to that question? I'm going to go back to our very first podcast where we were talking about lead follow and some of the questions that were floating around at the time. So do you have to sort of like have a scout's badge to say you can be a leader and then you have to go and kind of get that renewed, that kind of 007 license to lead? And I think, would you say that the market's worked that out for itself?
I think it has. I think the market has moved on already. One of the most interesting models for me is the Nephila model, for example. So under Ross Loud and what they have done with their syndicate there, where they essentially set up consortia and they approach other leaders because they look at the data that they have and they say, well, we think you're the best in class of business number one. We want to set up a consortium behind you and it's going to look like this. And here's how we want the data to flow to us. So they have a tiny population of mostly actuaries sitting in that business unit and they handle the business in that way. They just do it by managing the data. That's where they've got to, which I think is a fascinating place to be versus others who say, actually, we want to lead every big broker facility that's out there and we're going to ensure that our underwriters are appropriately skilled in portfolio management overall and portfolio analysis to lead that facility such that others will automatically follow us because they know our skill set when it comes to leading that particular facility.
And of course, when you talk to a broker, they don't want one leader. They also want potential alternative leader or two or three.
Absolutely.
To be healthy because, of course, that leader might have their capacity pulled at some point or something might happen and they might change their appetites. And suddenly, if you literally only had one and you had all your eggs in one basket, you can almost see it would be natural for brokers to want, and those clients, of course, those ultimate clients want to be able to fly in and meet those underwriters and talk to them when there's a big claim, when there's something that's grey area again as well. Because, of course, the one thing about algorithms is they're not very good at grey area. I mean, they're terrible at it. Yeah. And, of course, as we know in insurance, real life is much messier than that, isn't it?
But I'd say it's been the same with some of the broker facilities. They have also matured over time and got to a much more robust and stronger place. So we all live and learn and we all move our way forward.
Yeah, absolutely. And I suppose as long as the market's still competitive, you could have this leader-only facility where it looks like they've stitched up the whole aviation market because they've got a $4 billion line behind them, which would be crazy. But of course, that might not be competitive. That underwriter might end up not being competitive and think, well, I can do what I want now. It's like, well, other brokers and rival brokers or that broker will say, you know what, we need to probably instill some competition into this market. And before you know it, there'll be another $4 billion facility competing with it.
We need to ensure that we're doing the right thing by our clients, particularly from a competition law perspective.
Yeah.
And that there is choice out there for our clients and that they can choose to go with the underwriter who best serves their needs. The broker is the agent of the insured. That's what the broker is there to do, to ensure that there is a choice for those clients.
So would the lesson be that we should let the market decide what it wants to do because the market will probably have the right instincts generally?
Generally, I think the market has the right instincts. But that's where Lloyd's comes into play when it comes to PIBO and principles for business oversight. That's what their role is, to ensure that the outcomes meet the principles that they have in place.
You mentioned earlier about keeping the market profitable. We know that the market's beginning to soften. I've just had a wonderful series of perhaps the most happy CEOs of balance sheet carriers of most of them public companies. They've all posted record results. And I suppose they've all been around long enough to know that there might be the high watermark, but they've also been around long enough to know that they should try and enjoy the good times when they're here. The good times are definitely here. How do you keep them here without making people unhappy?
It's back to that point I said earlier around what the next CEO of Lloyd's needs to do. As John Neal said very early on in his days, he promised he would keep his foot on the throat of performance.
Yes.
And it's a good line. And I think the next CEO will need to keep their foot on the throat of performance. But at the end of the day, we're here to pay clients and to make them whole when a claim happens. So it is profitability over the cycle. That's what Lloyd's will need to focus on, is profitability over the duration of the cycle and ensure that that's where performance remains focused in this marketplace.
Worrying soft markets or softer markets tend to be where the demand stays the same. At the moment, there's demand all over the place for new solutions. There are so many new problems as well and potential new classes of business sitting out there that we can make the most of. Do you think, again, if we're match fit, we could really make the most of those? And do you think we're in a better position than we would have been 10 years ago, for example, to make the most of some of those opportunities? Do you think, we see things like carbon credit insurance, for example, which are fascinating cross-class and potentially very large new classes of business?
Look, this market is the home of innovation when it comes to risk. And it is the home of innovation globally. And that's what we are known for. We need to ensure that we continue to innovate in that space, particularly when it comes to new products for our clients. That's what we're good at. That's what we're known for. And that's why clients come here. So how are we going to protect and foster that environment of innovation and ensure that it grows whilst also changing how we work, be that moving to, some more facilities are in place, more lead follow type of arrangements where people define themselves as leaders or followers in particular classes and work in a different manner associated with that. But how do we change how we work as well as how do we change in terms of the innovation that we provide to those clients? This is what we're known for, but how are we going to foster that? And what are we going to do to ensure we don't lose that reputation as the global home of risk innovation?
That full digitalization will allow some of those new innovative classes to have limits spun up quite quickly around them. But once they've got a track record, I suppose you need to have that sandbox to be able to build that track record.
Lloyd's are already facilitating that through the ICX risk code. So It's a risk code where you can have up to 5% of your premium. You won't be judged on the performance of that particular class for a handful of years until it has got up and running. So that's what's behind that particular risk code. So people can go out there, can innovate, can play around, see, does this product meet the client need? Is it a good product from a client perspective, or do we need to shape it a bit more? Or what does the loss ratio look on that product after? If you've no experience of it and it's a brand new product, you need time to gather that data.
You don't get a 5-year loss record, do you?
Exactly. So that's what that ICX, the innovation risk code, sought to do. And I think it's absolutely the right thing to do to encourage that innovation forward and to take pressure off firms to say, you can play in this sandbox, as you put it. It's almost an innovation sandbox for those carriers.
On the culture question, which is when we first spoke, it was when that Bloomberg report about behaviours in the marketplace dropped and kind of dropped a bit of a bombshell in the whole of this marketplace. Well, we're in a really interesting geopolitical environment where it seems to be that the wind blows in one direction, blows the other. It seems to be going quite strongly in the other direction. Is that a problem in terms of our own cultural progress? Do you think it might, in terms of some of those targets on gender balance in boards and things like that? Is it something we have to be conscious of?
There's a line by Jon Stewart on The Daily Show. I don't know if you've heard it. It says, if you don't stick to your values when they're being tested, they're not values, they're hobbies. And I firmly believe that. Either you believe in this stuff or you don't. And if you don't, it's just a hobby to you. I believe in it, and I believe we've got to stick with it, because this for me is a talent play. And how do we attract the best talent to this marketplace? Well, if we're not reflective of the society which we serve and the client base in which we serve, we're never going to get the best talent into this marketplace. So for me, there is a huge imperative to keep this work going. We have a long way to go.
And you can attract it in, but then you have to make it stay as well.
Exactly. I mean, if I look around the 56 managing agents who are both live and run-off in Lloyd's, of the 56, there are 4 female CEOs. There are, I think, 2 or 3 from an ethnic minority background. We have a long way to go to become reflective of the society that we serve and of our client base. So I think there's a long way to go, particularly in underwriting. I think underwriting is a particular issue that we've got. If I look, first of all, at that CEO community, I'm going to guess probably 50 to 60% of CEOs come from an underwriting background. I'd say the next 20% come from finance, and then the balance come from the other functions like risk or regulation and so on like that. But the vast majority of our CEOs come from underwriting, from a CUO background. Then, okay, well, let's look at the makeup of the CUO community. That has some female representation in it, but if you look at the demographic stats that came out in March of this year from Lloyd's, What that said was that if you look at the pipeline of future CUOs, so CUOs who are going to be ready in 0 to 2 years, that pipeline last year was 18% female. This year is 15% female. So we're going backwards, and it's a problem. And how are we going to deal with this? And where is the leadership intent to change it and to make sure that we have in place diverse leadership who bring diverse opinions, who help us to make better decisions? You know, if I have a team that's made up entirely of people who look and sound and act and behave the same way as I do, they're just going to make decisions that I would make myself. I wouldn't need them there. I want diverse viewpoints around my table so that I can make better decisions and make better strategic calls and better serve our clients. That's where we need to get to. But we still have a problem, particularly in the underwriting space, and particularly in terms of those who are female and those from an ethnic minority background, who are senior leaders in underwriting. Where is the leadership intent to change that? If you have a value in your firm's set of values that says that you are inclusive, do something about this. Make sure that you have more than 15% in terms of your pipeline of the people who could step into the CUO role in the future. Where are you on that? And where is your intent to change that?
What about what we've been describing as non-financial misconduct? Let's just call it bad behavior. Obviously, we've had a lot of work on this. How can we best get the balance? I'll go back and sort of for financial misconduct or just kind of broking and underwriting misconduct back in the old days. You'd have a Lloyd's disciplinary report, and I can't remember exactly what they were called. They were kind of hearings, quasi sort of judicial style hearings. But then the nice thing was that a bulletin would be published and my compliance officer would print it out and have all our initials. We'd have to initial that we'd read it and learn the lesson from that, i.e. somebody had gone around and done a ton of policies and now they're not allowed. We can't do that anymore. We could all learn that lesson. There was a transparency to it, even if it was broker A, underwriter B, or whatever it was. But we could learn that lesson. This is more complicated because this is people and behavior. And obviously, because there was what someone did rather than how they did it. So it was far easier to make it transparent and something that you could then, everyone could know straight away within 6 months. It was a lightning bolt, went through the market and stopped doing a ton of policies they're not allowed. Great. Okay, we won't do that. Now, these are more subtle and difficult, intractable problems or cultural problems about the way people behave towards each other and also the way that they perceive each other and what is acceptable behavior that would have been acceptable 50 years ago that's not anymore, for example. So how do we do that in a situation where you understand that anonymity needs to be protected? It's a really difficult one. I'm sure you've thought deeply about this. So, because obviously the easiest way of stopping bad behavior is to show everyone what it is. Most of them would say, you should jolly well know what bad behavior is.
But we do. Anyone who says they don't know what bad behavior is nuts. I mean, come on. It's like, we do know what bad behavior is. We know it when we see it. And we know it through the stories that we hear. And we've all heard countless stories in terms of be that bullying or harassment or whatever the case may be. We know what this looks like. And people saying, well, I don't know what it looks like and I need it painted in big, large letters in front of me. Come on, get a grip. We all know what this looks like and we all know what it feels like. Can we describe and prescribe for every single situation? No, we can't. But we can have a set of principles in place that describe what good behaviour should look like. And that is articulated through the culture framework that Lloyd's already have in place. So that is already out there. The bit that bothers me is around encouraging people to speak up, number one, from those victims, and ensuring that they have confidence in that process, that they will be heard, that they will be listened to, and that they can go through the process in a fair way. That process must be fair to both victim and, at the time, it'll be an alleged perpetrator. It must be fair. It must be transparent. And I would like us to get to a place where we can have lessons learned when those things happen, when those cases go through, and we can all learn from them and go forward. We all know about the handful of cases that have gone on in the past and have been very public in terms of the press examination of those particular cases, which is fine, and that's what should happen. But we do need to protect the victims through this. And I would say at any point in time, I'm probably talking to one or two females who are going through particular issues in their own firms and they're looking for advice about how to handle it. But we all know what it looks like when we see it. So let's stop hiding behind the excuse of, oh, well, we haven't articulated that you must stand on one foot on a Wednesday and that's good behaviour, and on the other foot on a Thursday and that's better behaviour. That's not what this is about. We need to ensure we have a set of principles, which we do, around our culture and what is good culture. We need to ensure we have a fair and transparent process, which Lloyd's is working through at the moment to try and ensure that they improve the process and get it to a better place. We then need to ensure that that process is fair to everybody involved. But at the very beginning of that process, we need to have, and all firms need to have, sets of processes and procedures in place that encourage those individuals to speak up. Because if we don't have that speaking up, it's going to continue on. You can have the best process in the world, doesn't matter if people can't speak up.
Because people keep getting away with it.
They keep getting away with it because people don't feel confident that they can speak up and that they will be heard and that they will be listened to.
For some of those alleged perpetrators, the consequences are so serious that they're effectively career death is the punishment, whether or not they're actually found guilty one way or another. Is there a third way sort of solution, a bit like what South Africa did after apartheid, the kind of truth and reconciliation, somewhere where there is at least some hope of redemption so that the punishment for misdemeanors is not career death for those perpetrators who are people who need to learn to change their behaviour? Or do you think there is no redemption for some of those people?
This is up to individual firms to deal with. And I think if Lloyd's has to get involved and remove somebody's pass, for example, that's not a good place for any of us to be. Because what should be happening is firms should be able to deal with this internally through their own processes themselves. And many firms already do this. And they will both protect the victims and work with the perpetrators around what are good or bad behaviours, what needs to happen now and what needs to be different into the future. I would like to see Lloyd's less involved and firms more involved, and them having their own processes, having their own values in place, demonstrating to individuals that this is the type of behaviours that we would expect from our employees and this is how we want to take it forward. But is somebody redeemable or not in the longer term? That's up to those individuals. We all own how we behave each day, day in, day out. If people choose to behave in dreadful ways, which involves bullying and harassment of colleagues in their firms, I'm sorry, then they don't deserve to be employed by those firms anymore. How else are we going to change this marketplace? Either the individuals change or the firms themselves change how they treat those individuals. And that's where we need to get to.
I suppose the only counterproductive sense of that is the idea of keeping that all completely underground, because if they know the consequence is, I'll never work here again.
It's back to what I said at the beginning. This is about, number one, encouragement to speak up. Number two, protect the victims. Number three, have a fair and transparent process in place. And number four, share the lessons learned afterwards. Explain to people what happened, why did it happen, and what do they do about it. So it's as simple as that. That's what people need to do and firms need to do. Encourage speaking up, protect the victims, have a fair and transparent process that is fair to both the victims and the alleged perpetrators, and learn the lessons afterwards. That, to me, is open and it's transparent and people know what they're dealing with and what the level playing ground is, both to alleged perpetrators and victims. So we need to be fair to both sides and ensure that the process is robust and transparent. That, to me, is not then hidden under the carpet. It is open within the firm. People know when it is appropriate to share those lessons learned, that those get learned. But they talk about how do you speak up, what the process is, and how you protect victims.
Do you think we're there yet?
No.
So that's certainly, as you mentioned, it's on your agenda.
I think we are inconsistent across the marketplace. I think there are some firms who are utterly brilliant at this and who I look to learn lessons from personally. I know I speak with some firms who, you know, what they've done in terms of some of their policies and processes, which is fantastic and great. And then I speak with other firms and individuals or victims from those firms. I'm like, what are you doing? Come on, we can do this better. So there is a spectrum here of some firms who are utterly brilliant at this and some who have a very long way to go. But it's generally driven, in my view, by leadership intent. If the leader at the top of the tree wants the culture to change and wants a different set of processes in place, it will happen. It generally does when the leadership intent is there. If the leadership intent is not there, it doesn't happen. Just like if your leadership intent is, I'm going to grow premium by 20% next year or whatever the number is, you put in place a set of KPIs, you hold your team to account and you drive them forward on that basis. I see some firms who do that not just on the business side and on the revenue side or on the expense side, but also on the cultural side. And they hold their people and their leaders to account in terms of delivering to that.
And it's when they come into their review.
Yeah,
So
because,
it's,
but it's about that leadership intent. Where is it? And if your CEO at the top of the tree has no intent to change the culture, you should be asking them, why not? Why aren't we changing this? What are we going to do about it? Where is our talent pipeline on CEO of the future? Where are they going to come from? Why is it only people who look like you, Mark? Why is it only people like you? Why aren't there more people from an ethnic minority background and more females involved in that CEO of the future?
Sheila, thank you so much. That was really, really good, actually. Yes, I think if we can get there, then that will be beneficial for everybody.
It will. But the most important thing it will do, Mark, is it will make us more attractive for the best talent in the world to come to London. And that's what we need. That's what this is all about. This is about talent. And it is about bringing the best talent into this marketplace. And not just the talent that we've all known in the past, or we know Joe or Mary or Pat or whoever from a different firm. Why aren't we talking to Google around, we'll come in here with your talent. What are we going to do? How do we think differently about how we address the issues we've got in front of us? So for me, the culture argument is all about talent and having the best people in this marketplace to drive the best and most innovative solutions for our clients. That's what this is about.
Thanks so much, Sheila.
Thank you.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.